Hello all, welcome to GetintoIAS, and in this video we are going to deal with the topic External Trade and Capital. So this is a new lesson, External Trade and Capital. What is called as an external sector? See, normally under an external sector, it comprises of the exports and imports within the country. Okay. See, external sector deals with the export and import of goods and services and the financial capital between nations. Financial capital is like the debt instruments, like the bonds and shares. Okay. So the countries exports goods and services over which it has advantage over other countries and imports goods and services in which it lacks advantage over other. See, if India is here, if India is lacking in agricultural goods, it will import from US. If US is lacking in service sector, it will import that service sector from India. So this is called as what? The external sector in our economy. Okay. See, first coming to the balance of payment under the external sector. Fine. First coming to what? The balance of payment under the external sector. So we already dealt with the balance of payment. Again, we'll revise. Fine. So the balance of payment of a country is a systematic record of all its economic transactions with the outside world in a given year. Take 1 year. So in this 1 year, India has imported from which all country? India has exported to which all country? All this is recorded systematically. Fine. Next one, the term all transactions refers to transactions of the government as well as the private. So you have to keep in mind the transaction, all transaction means the government, what all transaction is happening between India and the outside world, and the private that is involved in the transaction in India and the outside world. Okay. Now it is a double entry bookkeeping. What is called as double entry bookkeeping? So under the double entry bookkeeping, we have the credit entry and the debit entry. What is the credit entry? What is the debit entry? See here, double entry bookkeeping involves recording each transaction twice, consisting of two opposite entries with equal values. One with a credit entry signifying inflow. So this credit entry is the inflow of goods and services, that is the imports. Imports is called as credit entry. Something is getting credited inside. So exports is called as debit entry. Something that is leaving your country is export. So that is debit entry. Fine. So these two are noted under the double entry system or the double entry bookkeeping. Fine. So under the balance of payment, you have two types of account. Okay. First one is the current account. Next one is the capital account. So under the balance of payment, you have current account and capital account. So inside the current account, it is similar to the revenue receipts and the revenue expenditure. Under the capital account, it is like the capital receipts and the capital expenditure. Fine. We already dealt with these. Please recall. Okay. So under the current account, first one, under the current account, you have something called as what? Trade balance. Before you could understand about the trade balance, you need to know what is export and import. So under export, you are exporting some product from here to another country. So for exporting, you will get money. So under this, the services are not taken into account. So under export, only the goods, merchandise goods are taken into account. The services are not taken into account. And under the import, you are importing something. For that you have to do payment. So the payment and the import is being related in the import system. Next, coming to the trade balance, this is only for the goods. Keep in mind, the trade balance is only for the goods and not for the services. So under the trade balance, it is the export minus the import. See, for a country like India, if we export more, we will get a lot of foreign currencies, right? And the import should be less. Fine. We should export more and the import should be less. Then the trade balance is positive. If the export is less and the import is more, then our foreign reserve is getting depleted, right? So that is called as negative trade balance. So there are two terms, positive trade balance, negative trade balance. Positive means export will be more and the import will be less. Negative will be the export will be less and the import will be more. Next, coming to the invisibles. Okay. Next, coming to the invisibles under the current account. So under the current account, you have export, import, trade balance, and the last one to be the invisibles. So under the invisibles, it is divided into services, transfers and income. So we'll deal with this separately. So I told you all under exports and import, services is not taken into account. So services is taken into a separate account called as invisibles. Fine. Over here, see, you know what is a service. export and import of services is accounted under this head called as services. Fine. So services include travel, transportation, insurance and miscellaneous services, which encompasses communication service, construction service, financial service, software service and so on and so forth. Fine. So all these are accounted under which heading? Services heading. Next, coming to the transfer. What is called as a transfer? See, transfers include grants, gifts, etc. For example, if country A is gifting to country B 1000 crore rupees. Okay, this is called as what? Grants. Gifts is if country A gifts something to country B, that comes under the gifts. So transfers means grants, gifts, etc. which do not have any quid pro quo. What is called as quid pro quo? Okay, so without any quid pro quo means that it need not be compensated or reciprocated. Once it is received, it need not be repaid. For example, the grants received from country A to country B need not be repaid. The gifts received from country A to country B need not be given back, need not be reciprocated. So this is called as quid pro quo. Fine. Next, coming to the income. What are the income in the invisibles? So income is divided into two, the capital and the remittances. So you have to keep in mind, for prelims they may ask you like the remittances comes under the capital account, but remittances come under the what? Current account, specifically under the invisibles. So you have to keep a note of all this. Fine. So next, coming to income. See, income includes transactions regarding income from investment in the form of dividends, profit and interest from loan, rent from house property and income generated through employment. See here, under the income, you know all these points. For example, so I am a citizen of country A, I invest in the share of country B. So after investing in the share, the dividends, I already told you all about the dividends, that is the profit will be divided into the number of shareholders. So I receive income by that way, I receive profit by doing a business, I receive interest from the loan. See, country A will be giving loan to country B, for that we will get interest, country A will get interest. So this is the income of the country A. Next, from house property. So in case if I have a house here, I generate rent from this house. So and income generated through employment. So if country A citizen is working in country B, he will generate what? He will generate revenue in country B. So all this comes under what? Income. So under this, remittances is a very important topic. Remittances. What is remittances? See over here. Remittance is directly earned by labor, which is a factor of production, and incomes like dividend, profit and interest are earned by capital. So I told you all, under capital, dividends, profit and all will be earned. But by remittances, it means it is earned through employment. It is earned through labor. Fine. So the income from both these heads is called as factor income services. So income from the capital, income from the remittances, all these is termed as what? Factor income services. Fine. So India is the largest remittance receiving country. Fine. Why? Because a lot of Indians are working in the Middle East country, USA like this. So our citizens send money to India. So our citizens send money to where? India, because these people are Indian citizens. They work in another country. They work in an abroad country and they earn. So that earning is sent back to the families in India. Okay. That is called as remittances. Fine. Okay. Now moving to the current account balance. So there is something called as the current account balance. What is this? See, current account balance means trade balance plus invisibles. Fine. Over here, if the current account balance is positive, it is said to be surplus, which means favorable current account balance. Surplus means favorable current account balance, that means positive. But if the current account balance is negative, if this is negative, it is said to be deficit, also called as unfavorable current account balance. Fine. Same way like the balance of payment, there is positive and negative. Same way we have current account balance, which is positive and negative, favorable and unfavorable. Okay. Next, moving to the capital account. So we are done with the current account. Now moving to the next one, that is the capital account. So under the capital account, they are two-way. So normally the current account is only one way. Okay. One-way transactions, but capital account is two-way transactions. Same way like the capital receipts and the capital expenditure. See, a loan given by country A to country B should be repaid back by the country B to country A. So that is a two-way payment. So that comes under the capital account. First one is the external assistance. So under external assistance, so only the government will play a role here. See, for example, external assistance means the transaction of official, that is the government, bilateral and multilateral loans. So country A is borrowing from country B. So that is a bilateral loan. Country A is borrowing from IMF or World Bank. That is a multilateral loan. Okay. So the bilateral loans are loans transaction between two countries. Multilateral loans are official loan transaction between a country and a multilateral body like World Bank, IMF, ADB. Fine. So we have done with that. Next, moving to the external commercial borrowing. I told you all external assistance only for the government. External commercial borrowing is for the private, for the commercial units. Fine. So over here see, commercial borrowing means loan transaction by commercial enterprises, by the commercial companies. Fine. It is also called as external commercial borrowing. So ECB, external commercial borrowing, refer to commercial loan in the form of bank loan. So over here I'll get bank loan, buyer's credit, supplier's credit, securitized instruments availed from non-resident lenders with a minimum average maturity of 3 years. For example, see, I may get, so I have a company in India, so I may get loan from a US Fed bank. So I may get loan from a US bank, okay. So this loan is lent to me by the US bank. So this comes under what? External commercial borrowing. I have to repay this loan back to that country's bank, right? So we'll deal with that. And this is normally the maturity period of this loan is normally 3 years. Fine. Okay. See, external commercial borrowings can be raised for a specific purposes such as import of capital goods, implementation of new projects, etc. This restriction is called as end-use restriction. What is called as end-use restriction? See, I am here. So, I am in India. So, I want to do a road project. Fine. So, for that, I am availing loan from the US bank. Fine. So, that is being, so US bank is providing me loan. So, that loan, I am using it for the construction of the roadways. Fine. So that is called as what? External commercial borrowing, but for a specific purpose, that is the road construction. That is why it is called as what? End-use restriction. So I should use that money only for the road construction. That is why it is called as end-use restriction. Next, coming to the heading of, the heading external commercial borrowings also covers foreign currency convertible bonds and foreign currency exchangeable bonds. So bonds are a kind of debt instruments in which we can borrow, right? So external commercial borrowings is divided into two, that is the foreign currency convertible bonds and the foreign currency exchangeable bonds. So what is foreign currency convertible bonds? In that, FCCB are bonds issued by an Indian company expressed in foreign currency. The principal and the interest in respect of these bonds are payable in foreign currency. See, for example, in India, there is a company. This company is issuing bonds. So, bonds are debt instruments. So, because this company is in need of money, that is why it is issuing what? Bonds. Fine. These bonds, right, are issued by the Indian company but expressed in foreign currency. For example, dollar or yen, it may be expressed in that. For example, if it is an Indian currency denominated bond, the bond will be like 100 rupees. Fine. But since it is a dollar denominated bond, it will be like $100. Fine. So I have to give dollars and then get back the bond. Okay. So these are called as foreign currency convertible bonds. They are converting the bond into foreign currency and not Indian currency. Okay. See, foreign currency exchangeable bonds, FCEB means, are also expressed in foreign currency issued by an issuing company. So, these are issued to persons who are residents outside India. See over here, these bonds are issued to persons who are outside India and not to people inside India. Okay. So, these bonds won't be issued inside our country. For example, it will be issued outside our country. So, those bonds are called as foreign currency exchangeable bonds. So, what is happening inside the bond is, these are exchangeable into equity share of another company called offered company. So, for example, say I am borrowing from the US citizen. Okay. Next, I am converting these debt instruments into shares. How is that possible? I told you all. See, I will borrow money from these people. I will use this money and I will invest in another share in another company. Okay. This company over here which I am investing is called as offered company. So normally I am getting money from somewhere outside. Okay. And I am investing in some other company and not in my company. Okay. So the some other company is called as offered company, who is offering me to invest in their company. Okay. I hope you got the point. Now see, the principal and interest in respect of these bonds are payable in foreign currency because they got in foreign currency and the principal and interest will be paid in the foreign currency. So the word exchangeable, so foreign currency exchangeable, right? Exchangeable bonds. The word exchangeable means refers to the facility to convert the bond of one company into equity share of another company. So I told you there is company A. What this company A is doing, it is issuing bonds, okay? So by issuing these bonds, it is getting money from some other country, say US citizen. And what this company A is doing, it is converting this debt instrument, that is this bond, into share of another company. So that is why it is called as exchangeable. Bond is converted into share. That is why it is called as exchangeable. So these comes under the external commercial borrowing because this company A is borrowing, okay? Next one, short-term debt. What is called as a short-term debt? So, short-term debts are trade credits for a maturity of less than 3 years. If the debts are less than 3 years, it is called as short-term debt. See, if company A will be borrowing from this person. So, company A has to repay the debt within 3 years. Okay. So, these are called as short-term debt. Next, coming to the banking capital. So, we're done with external assistance, external commercial borrowing, short-term debt. Now, moving to banking capital. What is a banking capital? See, banking capital comprises of 3 other components. First one is the foreign assets of commercial banks. See, commercial banks in India will have assets from the foreign company. Okay, so those assets will be stored inside this commercial bank. So that is called as what? Foreign asset commercial banks. Next, the second one is foreign liabilities of commercial banks. Liabilities means they should give back the loan what they've got from outside. So those are the liabilities of the bank. Next one, other subheadings. Okay. Let's meet the foreign assets. So under the foreign asset of the commercial bank, what is a foreign asset? Foreign assets of a commercial bank consist of foreign currency holdings and rupee overdrafts to non-resident banks. So under the foreign assets, so normally the foreign currency holdings, for example, the forex reserves, right? Foreign currency holdings is being held in the bank. So that is the asset of the bank. Fine. Next one, foreign liabilities of commercial banks means non-resident deposits. See, NRI. So NRI will be depositing inside a commercial bank. That should be repaid to the NRI at a specified date. That is the liability of the commercial bank. Next one, second liability is the liabilities other than the non-resident deposits, which comprises rupee and foreign currency liabilities to non-resident banks and official and semi-official institutions. So there are certain deposits in which the commercial banks has to give back to certain people, give back to other banks also, give back to other institutions also. So all those are the liabilities. So the deposits are the liabilities of the banks, right? Same way these commercial banks also have certain deposits from the NRIs, other banks and other institutions. It has to give that back to those people. Okay. So next one, the others. Other subheading under the banking capital is, see, so under others, under banking capital include transaction imbalances of foreign central banks and international institutions like the IBRD, IDA, ADB, IFC, IFAD. So these are all the sub-institutions of the World Bank and the IMF. Okay, maintained with the Deposits Accounts Department. This is called as DAD. So DAD account is like, see, the commercial banks, right? It will be holding certain deposits. Okay, those deposits will be like the money will be taken and being paid to the IBRD or IDA. Fine. So those are called as the DAD accounts, Deposit Accounts Department of the RBI, as well as transactions in balances held abroad by the embassies of India in London and Tokyo. See, I'll repeat, under the other subheading. So under the other subheading, under the banking capital, so there are a lot of assets and liabilities holded by the banks, right? So under the others, we have the transactions in balances of foreign central banks and international institutions. So RBI has to pay certain amount of money that it got from the World Bank or the IMF, right? So all those has an account under the RBI. So that is called as DAD. DAD is Deposit Accounts Department. Fine. Okay. So much is enough. So under the banking capital, under the others, you remember RBI has certain deposit account, that is the Deposit Accounts Department. So under this, the loan amounts that the RBI borrowed will be given back at a later date, at a maturity date. Okay. Now coming to the non-resident deposits. non-resident deposits. Under this we have three subheadings, that is the foreign currency non-resident banks, foreign currency non-resident banks, non-resident external rupee accounts, non-resident external rupee accounts, and non-resident ordinary rupee accounts. Okay, so these are the three subheadings under the non-resident deposits. We'll deal with one by one. Okay, foreign currency non-resident banks. So under the FCNR, foreign currency non-resident banks, what is the objective of that? See here, these deposits are held in the following foreign currency. So in these banks, we have the following currencies, that is the US dollar, pound sterling, euro, Japanese yen, Australian dollar, and the Canadian dollar. So we have all these foreign currencies held in the foreign currency non-resident bank. Fine. Next one, only term deposits of 1 to 3 years maturity is allowed. You know about the demand deposits and the term deposits, right? So only term deposits will be held in the foreign currency non-resident banks. Okay. So the interest rates are pegged to Libor and swap of corresponding maturities. So we have certain interest rates, right? In India, the interest rate depends upon the repo rate, reverse repo rate, and the marginal standing facility. But when it comes to the international market, the interest rates are pegged to Libor and swap. What is Libor and swap? See, under Libor, Libor stands for London Interbank Offer Rate. So it refers to the interest rate in the London call money market. So we already dealt with what is a call money market. So the interest rate of the London call money market is pegged under the foreign currency non-resident banks. Okay, the interest rate is pegged under the Libor. Libor stands for what? London Interbank Offer Rate. Next, coming to the swap. So what is the swap? Swap is a common agreement for exchanging one with another in the financial market instruments like debt, share, etc. Exchange can be between shares, between debentures, etc. So here swap is the exchange of loan in one currency to another currency. Okay, so I am exchanging one currency to another currency. Okay, exchanging my loan. Fine. So the interest rate swap difference between these loans is called a swap rate. See, for example, I borrowed in dollars. So I am willing to swap from dollars to yen. Okay, this is called as swap. But what is swap interest rate? See over here, swap is the exchange of loan in one currency to another currency, but the interest rate difference between these loans is called as swap rate. So over here, dollar will have certain current of interest rate, yen will have certain current of interest rate. So the difference between these is taken and the interest rate is pegged. Okay, so this is called as what? Swap. So the interest rate is pegged under the Libor and swap. Next, coming to the non-resident external rupee account, NR, non-resident external rupee account. Under these deposits are held in Indian rupee. Over here, the deposits will be held under all these currencies. Under the non-resident external rupee account, it will be held in Indian rupee. Deposits will be in what? Indian rupee. So the term deposits with maturity of 1 to 3 years as well as savings deposits are allowed under this scheme. See over here, we saw only about the term deposits. Only term deposits can be deposited, but over here we have term deposits as well as the saving deposits. Okay, and then over here also there are interest rates. So the interest rate is also pegged to Libor and swap. Next, coming to the non-resident ordinary rupee account. So NRO, non-resident ordinary rupee account. Under this, it is the account held by the Indians ordinarily living abroad. See, in case if I am in India, so I will be moving to US next month. So I will be deciding to come back to India after 1 or 2 years. So I will be having certain amount of account in India, right? That will be changed to non-resident ordinary rupee account. Fine. So an Indian who was an Indian resident but migrated abroad can shift his account to this category, that is the non-resident ordinary rupee account. So it is held in Indian rupee only. So the non-resident ordinary accounts can be opened as current, savings, recurring or fixed deposit. It is normal as the Indian citizens account. Okay. Next one is the foreign investment. What is called as foreign investment? See, foreign investment is divided into two: foreign direct investment and the foreign portfolio investment. So this foreign direct investment means any investment greater than 10% is called as FDI. FPI is otherwise called as rentier investment. Okay, rentier investment, and any investment less than 10% is termed to be foreign portfolio investment. Okay. So I'll repeat. See here, there are two types of foreign investment. One is the foreign direct investment Another is the foreign portfolio investment. Portfolio investment is otherwise called as what? Rentier investment. Okay. Next one, we'll deal with FDI alone. So under FDI, the investments through the mode other than the stock exchange is called as foreign direct investment. Very important. This was asked in Prelims 2020. Very simple question. What is called as FDI? The investment other than stock exchanges. See, we already dealt with stock exchanges, right? Many companies will be listed in the stock exchanges. You can invest in the shares of these companies, and after the profits or the loss, so in case if the company is facing any profit, the dividend will be shared. Okay, that is why it is called as a share. But FDI is not a sharing instrument. So other than the stocks, if you invest in some other project, that is called as foreign direct investment. Okay. So I'll repeat, investment through the mode other than the stock exchange is called as FDI. There is no prescribed size to treat an investment as foreign direct investment in India. So we don't have any size. Okay. So FDI includes what? Shares acquired by the way of initial public offering. So I told you all about IPO, initial public offering, in the sense any startup first time it is issuing shares means it is called as what? Initial public offering. So anyone who is acquiring shares in the IPO comes under the foreign direct investment. Fine. Shares acquired by way of preferential allotment, shares acquired by the way of offer for sale through private arrangement, transfers of shares by way of offer for sale through private arrangement. See, we already dealt with offer for sale. Okay. So in all these purchases, there is a direct contact between the securities buyer and the seller company. See, there is a seller company. Okay. And I am the securities buyer. I go buy it from the seller company. So there is a direct contact between me and him. That is what is called as foreign direct investment. Okay. So I told you all there is no definite size for the FDI, right? So Arvind Mayaram committee, please remember this committee. Arvind Mayaram committee recommended that an investment more than 10% should be treated as what? Foreign direct investment. Okay. So next, coming to portfolio or rentier investment. Over here, investment through stock exchange, that is through the secondary market, is called as portfolio investment. See, it is the opposite of FDI. FDI is the investment other than the stock exchanges, but FPI is the investment in the stock exchanges, that too in the secondary market. I told you all about the primary market and the secondary market. So investment in the secondary market is to be treated as the foreign portfolio investment. Fine. So under this, portfolio investment refers to the investment in various financial instruments like shares, debentures of a company through the secondary market. So there are three major types of portfolio investment. So first one is the foreign institutional investment, FII, depository receipts, and the offshore funds. So there are three kinds of investment under the FPI: foreign institutional investment, depository receipts, and the offshore fund. What is called as foreign institutional investment? See, under FII, it is the portfolio investment by foreign institutions like mutual funds, insurance companies, pension fund, etc. in shares and debentures. For example, see, I told you all about the mutual fund company. What they'll do, they'll pool in money from various people, club it together and invest in various securities, right? Through that they get the profit. Okay, so these people are called as what? Foreign institutional investors. Fine. So not only these people, the mutual funds, insurance companies and the pension funds invest in some other securities. So all these people are called as what? They are called as foreign institutional investors. Next, coming to the depository receipts. So we've done with some topics related to external trade and capital. Let's continue in the next video. Thank you for watching, and please subscribe to GetintoIAS and follow our Telegram channel in the description box given below. Thank you.